Welcome to this public lecture on financial history. It's a great pleasure to have tonight this year's guest professor, financial history, here for the talk, Rui Esteves. I will shortly come to your CV. Let me first say a few words on this guest professorship that was inaugurated about 10 years ago due to a generous grant by Metzler Bank on the one hand side, and at the time Rothschild. Later Rothschild was replaced by Friedrich Förderungsstiftung, so we are happy to have these two sponsors for this event. And the lecture tonight is organized, as you can see from the various icons here, as a joint venture of the House of Finance, the Leibniz Institute for Financial Market Research, SAFE, the Center for Financial Studies, and the Institute for Banking and Financial History, IBF. The chairman of IBF, Klaus, will later chair the Q&A session, and we now will listen to the talk by Rui Esteves. Rui Esteves, who is a colleague from the Geneva Graduate Institute, where he held a professorship in international history and politics. He joined Geneva in 2018. That's correct?
Correct.
He has a PhD from Berkeley and held academic positions at Oxford and Simon Fraser University. He is a globally known specialist in monetary and financial history, dealing with globalization of finance, with financial crisis, with sovereign debt issues, and with exchange rate regimes. And also deals with, I find very interesting, rent-seeking and corruption in public office. Also certainly something that's worth investigating. Tonight we will hear about debt consolidation in history. So I guess it will be an interesting tour through historical episodes on debt and debt consolidation. And I look very much forward to that. Rui, the floor is yours. Thank you.
Thank you very much. So sound test, can you hear me well? Yeah. So let me start by retributing the invitation and saying that I'm very happy to be spending this time as the visiting professor of financial history. It's especially enlightening and heartening, rather, to see that a powerhouse in financial research as the House of Finance takes financial history in consideration and importance. So I hope I'll contribute to that idea with today's presentation. Oh, my slides are not showing yet. There you are. As Rainer mentioned, the topic of today is debt consolidations in history. I am indeed going to give you a broad sweeping panorama of 2 centuries of debt consolidations. But before I start that, I feel the need to define what I'm going to talk about, because as frequently in economics jargon, the same words frequently mean several different things. But before that, if we needed a motivation to talk about public debt today, in early 2025, we wouldn't need it, right? We know that the world is in a period of exceptional debt accumulation worldwide. This picture comes from the latest financial monitor published by the IMF, one of their 3 flagship publications. And you see the subtitle of this one is pretty obvious, right? Putting a lid on public debt. Why? Because as you can see from the black line, the global level of public debt, so government debt as a fraction of GDP, has been going up and up and up and up since the global financial crisis, right? Since 2008, one of the consequences of the financial crisis is that global debt ratios, public debt ratios, went by about 15% of the world GDP over about 3-4 years. And then a second shock, which we lived through more recently, the COVID pandemic, hyped them again by another 15%, right? So overall, world debt to GDP ratios went out by 30%. And as you can see from that gray area, the IMF forecasts are not very positive, right? There's a lot of compression, but you see that the slope is slightly positive. So even the IMF is not seeing any obvious solution to the accumulation of these debt levels. So what do I mean by consolidations? I'm going to refer to as episodes, some of them sustained in time, so prolonged periods of significant reduction in debt to GDP ratios. So that's what I'm going to call debt consolidations. I'll use a little bit of notation as I go down. So let me introduce it here. So I'm going to be considering here historical episodes of reductions, not of nominal debt stocks, but on the burden or the size, whatever you want to call it, of those debt stocks in the size of the economy, right? That's going to be the small b figure, which is just the ratio between nominal debt stocks, that's capital B, and nominal GDP, right? Real GDP, capital I, times some price level. So we're going to look into history of episodes where this ratio came down significantly. But there are many ways governments can bring down their debts, and some of them are less friendly, namely to the creditors. And we're actually going to exclude all of them, right? So we're not going to call debt consolidation episodes where governments convert or consolidate. That's why I'm spending this slide defining terms, because consolidation has other understandings, where they convert their existing debt stock into other new bonds in a non-NPV neutral way, right? Where essentially they force their creditors, their bondholders, to restructure the debt in less generous terms. So we're not going to consider those. We're not going to consider situations where debt levels come down through global or bilateral debt reduction initiatives. So the last two ones I mentioned there, I'm sure you've heard of them. Two waves of multilateral debt reduction, debt forgiveness, the High Indebted Poor Countries Initiative of the 1990s and the Multilateral Debt Reduction Initiative of the 2000s. The first one, maybe you have heard of it. Has anyone ever heard of the Hoover Moratorium 1931? Right, I see some nodding. This essentially was an episode in the midst of the Great Depression where President Hoover from the US essentially not forced, but made possible a global stop on the payments of sovereign debt around the world, which very quickly then led on to a bunch of debt restructurings, defaults, and so on. So those are not going to be considered. We're not definitely going to consider any debt restructurings or outright defaults, right? So these are all situations where this ratio comes down, not through a forcible intervention of the government, through a default, or some kind of generous international intervention that allows for debt forgiveness and so on, all right? So I want this to be clear. Now, the other thing I want to do with this lecture today, I'm going to present you evidence on the prevalence of these historical debt consolidations, but I also want to raise a second question, which is, what's the role of inflation in maintaining debt sustainability? Okay, so you already saw the picture on the left. The picture on the right is just one of the many possible pictures. This comes from the FT, after 2021, because of the re-emergence of inflation. The FT allows you to, plot the inflation level of your favorite nation. I chose 4. So you have the US and the Eurozone. And as you can see, and those are the low, does this work? Yes, those are the low frequency, the low variables here, which then suddenly go up in 2021 and then have come down after our more recent period of disinflation. And indeed, inflation just came out of somewhere, right? We almost had forgotten about it in developed nations, in almost the whole world, right? Although, that's partly a bias of perception, because if the world included, even the major emerging nations, you see that there was considerable recent volatility in inflation levels. But indeed, the whole world coordinated into an inflation spike. Why is this relevant? Well, maybe you noticed this in the previous figure. Within the overall positive trend or increasing trend of global debt to GDP ratios, there's only one interruption, and that interruption is precisely 2021, 22, and early 2023. And that's a fact, right? Maybe nobody was expecting inflation. Maybe inflation was driven by real factors, structural factors, or political factors like the Ukrainian war nobody could control or foresee ahead of time, but it's a fact that this bout of inflation managed, at least temporarily, to interrupt that, apparently unstoppable trend towards global debt raises. Now, of course, this has been observed and profusely discussed in the literature and general media, so these are just reported examples. There's Daniel Gross writing about the stabilizing effects of inflation, which is something nobody really talked about 5 years ago, right? The Wall Street Journal, they also picked up this, although there's some caveats say, yeah, in the short run, but there's policy problems here, right? Because this should not be an invitation for unresponsible fiscal policies. We can't just solve our debt problem by inflating it away. And even the FAZ, right, last year in March, the Sonntag Ökonom, which I guess is an attempt to popularize economics to the general public, was talking about the enduring lure of inflation. I don't know if you can see it here. Steigende Preise sind gut für den Staatshaushalt, glauben manche, wenn sie sich da mal nicht täuschen. Right? So hold your horses. Right? Some people think this is the simple solution, but actually there's more to it. And of course, the fact that there's more to it is very well known for a long time. So here's a famous example. John Maynard Keynes, very young John Maynard Keynes, wrote this super famous book, The Economic Consequences of the Peace, mostly as a reaction against what he saw as the unhelpful terms of the peace settlement in Versailles in 1919. But he also wrote about public finance, right? And towards the end of the book, he has these two sentences where it is essentially warning that the significant monetary overhang that was hanging over European nations at the end of the war, plus the likely ongoing budget deficits for reconstruction and because of political wrangling, might turn into a debilitating inflation. And actually it was very pessimistic, right? He was saying, this can even, affect or endanger our settled social and political mode. So he was worried that trying to inflate debts or generating inflation to wipe out debts might actually engender the capitalist and liberal system that had existed at the time. I like to cite Keynes in this context because he hasn't really come down in history as the most fiscally conservative economist, right? But even Keynes, at least in 1919, was, raising awareness, be careful with inflation, okay? All right. So since I was trained as an economist, I always feel the need to have a preview slide just to let you know where we're going. And so, as I told you, what I'm going to show is based on an historical study, which is, involves the collection of comparative data on close to 180 nations over 220 years. So that's the scope of the evidence I'm going to show you from 1800 to 2019. Me and my co-authors, which I'm just about to cite, we embarked on this project because we felt, having worked for many years on the history of public finance, that the historical and the contemporary literature is excessively obsessed with the dark side of public debt, meaning defaults and restructurings, right? The literature on sovereign debt is, immense, right? But we thought that there was not enough appreciation for these more benevolent or successful cases where nations were able to reduce their debt burden sustainably and in large amounts without having to get the way of restructuring their debts, okay? The other thing we do is that we develop a framework to try to decompose retrospectively what were the main drivers of these successful debt consolidations, right? And the main ones are obvious, right? So how do countries, reduce their debt ratios? Well, they can grow out of debt, right? So if there's economic growth, that helps. They can go the way of austerity if they generate budget surpluses. That helps, of course. What's the role of markets, financial markets? Can financial markets make it easier by lowering the yields, right? So there's all this interesting discussion whether fiscal austerity actually reduces yields and how much. And then finally, also, the topic I'm going to introduce today, again, which is inflation. Has inflation helped historically? We're going to show you that, yes, we find that countries were more likely to undergo these debt consolidations in periods of rising prices than definitely in periods of deflation. but not in the historical cases of largest inflation runs, right? Definitely not in post-war inflations, not in the very famous great inflation of the 1970s. Those are not periods where a significant number of nations are consolidating with the help of inflation. And so actually the big conclusion that we're going to get from here is that more important than just, irresponsibly inflate away your economy, surprising everyone with a bounce of inflation to reduce the debt burdens, inflation can actually help in periods of remarkable macroeconomic stability, low but predictable inflation, sustained by credible policy rules. Okay. All right, so I want to acknowledge that this is joint work. It's joint work with 3 co-authors, Barry Eichengreen from UC Berkeley, Alsma Elgenainer from the IMF, and Chris Michener from Santa Clara. What I'm going to show you comes from these 2 sources, a book we published in 2021. Notice the title, In Defense of Public Debt. Again, we're trying to make a positive contribution for the historical and ongoing importance of public debt, rather than just saying that, debt always ends up in tears. And the other paper on the right-hand side, which is the one where we developed the framework to decompose ex post the sources of these debt consolidations, and in particular look at the role of inflation. Now, having defined debt consolidations, you probably immediately saw that there's an implementation problem here, right? Sustained and substantial. What is sustained? What is substantial? Okay? So there's a variation here, since there's no obvious definition of what is a sustained period. Is it 1 year, 2 years, 3 years, 5 years? How many years? There's also no obvious definition of what is a substantial level of debt reduction, right? Is it 10%, 15, 20, 25? We experimented with several definitions of these thresholds, right? In particular with these 6, most of the evidence I'm going to show you comes only from the first. Notice what distinguishes the first from the second is that we do not impose a minimum duration, right? We say sustainable is whatever it took for countries to reduce their debt burdens by at least 10%. Some nations were lucky, they did it in 1 year. Some nations took longer, right? So some nations do it faster, some nations took longer to get there, but if they take long, they need to do it in a sustained way. Somehow they need to generate the political and economic equilibrium to be able to reduce their debt year in, year on, right? And I'll show you examples of that, okay? The other thing is that if we use one of the last 5 criteria, we're effectively imposing a minimum rate of this inflation, a minimum rate of consolidation. So for instance, if you take the second variant, 5 years at 15%, that means that these countries have to reduce their debts at least 3% of GDP per year. Whereas, for instance, the last one, 10 years, 15, they get away with half of that, okay? So let me give you an actual example of what's the implication of this. So I'm going to take Spain as an example. So this is the evolution of the Spanish debt over GDP ratio from 1850 to 2019. There's an interruption here. This is the Civil War, for which we don't have good enough data. So what we see from here, well, this looks like the Alps, right? So there's very big mountains, and then, once you go up, you tend to tumble down afterwards, right? And indeed, some of these debt consolidations, these debt reductions, are actually out of our purview, right? In particular, during this period, there were 2 defaults, right? 2 periods where the Spanish government just said, I'm not paying, let's renegotiate, right? So we're going to forget those parts of Spanish history, right? In what I'm going to tell you about today, there are no defaults, no restructuring, no debt cancellation, okay? So let's apply the first criteria, right? The first definition only requires that debt comes down by 10% over whatever period. If you apply it, our filtering algorithm finds 5 of these debt consolidations, right? So some are very short, right? So there's one here, that's in the 1870s, there's another one there at the beginning of World War II. These are periods, 1-2 years, where public debt came down very quickly, but then notice that there were reversals. So that's where we stop our episode. Whenever that starts coming up again, there's no longer a question of consolidation. But then there's also other periods of longer debt consolidations and very large ones, right? So you have this one after World War I, this after World War II, and another one around the beginning of the century, okay? So this is if you do not impose fixed durations, right? If you do, For instance, if you consider only periods of 10 years of uninterrupted debt consolidation, this is the green bars, right? You can see that this imposes some restriction. You're filtering fewer episodes. So what happened to the second part of this long consolidation? Well, unfortunately, between here and here, you have fewer than 10 years, and then, that starts going up, right? So this would not be filtered as one of these episodes. Same thing with 5 years, right? So this is just, just a piece of warning to say that, you need to think carefully about what kind of a concept you want to impose onto the idea of debt consolidations, because this may matter very significantly to the episodes you identify. And if you ever want to use our database of episodes, beware, right? If you ever want to run regressions on some empirical analysis with these episodes, beware of the data restrictions that the choice of the threshold will impose. So in order to impose the fewer restrictions as possible from now on, I'm only going to talk about the blue cases, right? The ones where we don't impose a minimum duration. How did we do this? Economic history, and financial history in particular, I strongly believe is important, can bring you a lot of important insights. There's a lot of useful economics in history, but it takes time, right? Namely because we can't just download the data sets. We have to build it ourselves. Although I have to say that in this case, we were helped by 2 flagship databases put up by the IMF. Those are the first 2 ones, by IMF researchers, and that we were able to use, and this was definitely of a lot of help. More recent databases put up by the IMF and the World Bank also help us in collating the macro and financial information we needed. But in the end, since we went back to 1800, we had to do a lot of data work ourselves and look at a lot of historical data sources. Some of them are older. On the right-hand side there, do you know this publication, the Statesman Yearbook? Still exists. Much less known than it used to be. And actually, it's the best source for budgetary information of nations across the world before 1850, right? So whenever we get at the very early period of our investigation, this is where we got most of the data. And here in the down part, you have internal publications from the big multilateral agencies, the IMF on the right-hand side. This is a report about Cape Verde. And on the left-hand side, you have the World Bank reporting on Tunisia. And the good thing about these multilaterals is that they have to share the data with you because they're international public organizations. They also share all their reports. So a lot of legwork. We didn't have to go to DC, right? Because all of this is available online. But we managed to piece a lot of information that was not even available in their own data sets. So this is how we did the work. It took almost 2 years to collect all the information. And we managed to do it thanks to generous funding from the Bank of Spain. I should have acknowledged them as well earlier on. All right, so here's the first view at the summary statistics. So what we have here is a simple table of averages, means, and maxes, and numbers, right? So how many consolidations did our different versions of our threshold filtering method identify, right? So if you impose no minimum duration, we found 378 consolidations with an average duration of 5.8 years, and a maximum, the longest consolidation we found, lasted for 36 years, right? 36 uninterrupted years of debt reduction, okay? How big were they? So how much did the debt to GDP ratio came down? On average, about 32%. That's a lot, right? And the champion, the leader, is 265%. I could ask you if you could guess which country did it, but I don't think you would guess it. It was Liberia, actually, right? There's a lot of unknown and unappreciated historical facts about that consolidation. I forgot. Actually, these statistics do not refer to the full 378, but only to 3/4 of these debt consolidations, because as I mentioned, we're going to try to decompose the drivers of these debt reductions, and we couldn't find the information on all the variables for all the consolidations. We only have it for 75. Same thing applied to all the other concepts. As you can see, the data rationing is less serious there, but we filter much fewer of these debt consolidation episodes if we impose more restrictive conditions, as you would expect. All right, here's another way of looking at the data, visual one. So this is a time series of the frequency of debt consolidations over time, from 1800 to today. That's the black solid line. So the way to interpret this is the percentage of all sovereign nations existing in each of these years that were undergoing a debt consolidation as I described. So what can we see from here? Well, there's a lot of variation, of course, right? So there's some lean periods. So the period before World War I is relatively lean, right? The maxima is slightly above 10% of countries undergoing debt consolidations. Then there's some action here in the early part of the 20th century, then there's a trough, and then there's a peak again. But you notice that there's two other time series represented there. There's the frequency of defaults and the frequency of debt relief. The debt relief is this blue line, right? And it has two peaks, which coincide obviously with the two initiatives I mentioned earlier on, right? The HIPCI and the MDRI. But what I want to also emphasize here is that, there are, of course, peaks of defaults, right? And we all know this story. They essentially follow major financial or political crises. So, for instance, this is the first Latin American debt crisis of the late 1820s, 1830s. This is the 1876 financial crisis. This is the Barings crisis. This is the Great Depression. And this is the second Latin American debt crisis. We all know of that, right? And there's periods where a significant fraction of existing sovereigns were undergoing debt restructurings and defaults. But it's not always the case that default always trumped everything. And so there are also periods, I'm going to focus on this period and the more recent one, where actually debt consolidations were much more prevalent. Again, the emphasis being here, we're so obsessed with understanding the causes and the consequences of defaults that we forgot, right? That debt consolidations not involving restructurings are probably more prevalent and more significant than defaults. In particular, we're on a mission to try to push the idea that in particular the more recent period, and this is something since the mid-1980s, is a period where a very significant fraction of all types of nations around the world managed to reduce their debt to a very large extent. And actually, we've been trying to push a new great term, right? The Great Consolidation. We would be very happy if you guys would retweet it or re-X it or mention it, right? Because we really want to emphasize that this is really a special period, right? Look at, compare the relative frequency of debt consolidations to defaults. Defaults are actually on the trough, and even debt relief. Okay. Now, of course, all of this stops with the financial crisis, but it doesn't go down to zero. It's not replaced by a wave of insolvencies and so on. Okay, so that's frequency. How big were these things? So I already showed you the bare averages. It might be also more interesting to look at the actual histogram, right? Rather than just give you the average, the minimum, and the maximum, let's look at how the size of these debt consolidations, so how much the debt over GDP came down, which is what you have here on the x-axis, is distributed over the whole period. By construction, this histogram has to be to the left of the zero line, right? Because we wouldn't call anything where that went up a debt consolidation, so it has to be negative. It's obviously skewed. Most of these debt consolidations barely made the minimum 10%, right? So this large bar here is the 10% minimum reduction in debt over GDP. But there's there's a very long tail as well, right? So there's Liberia, again, hiding, 265% of GDP. Yes?
What are they with this? So like, is that then going into surplus? Like, how do they get below 100% negative?
Of GDP, right? So if you start with 300% of GDP as a debt, and you cut down to 165, you still have 35, right? This is not related to the debt stock, it's related to GDP. All right? This is how much your debt came down as a fraction of the size of your economy. All right? The other thing, you notice that there's another histogram superimposed here, and this is the histogram of what happens to debt after defaults. Or actually after 5 years after the end of a default. Because, defaults, countries default for a reason. They don't want to carry the existing debt levels. And what's interesting is that you notice that there's a positive side to this histogram. And this is essentially because many of these debt restructurings are done on or close to NPV neutral terms. Frequently, one of the, the arrangements is that the defaulting nation will pay lower yields from then on, but of course, the investment banks or the investors require higher capitals to compensate for that, higher principals, right? So it's frequently the case that countries come out of defaults with larger nominal debt stocks, okay? And here's the table if you prefer tables, right? So you had already seen this 32%, that's the mean size of debt consolidations. 20% is the median, that's the extremes, and this is for default. And actually it's interesting for default because the median and default size barely does not touch the size of debt, okay? Now, we also, since we have the full period, we can splice the data in several ways. One is by macro-historical period. These periods are self-evident for economic historians. Let me just say a little bit about them to you. The first one, the top side, this is a period before World War I characterized by a policy mix where you have essentially non-independent monetary policy because most nations peg their currencies to some kind of commodity money, silver or gold, right? So this ends up with the so-called classical gold standard. So no activist monetary policy. And also with very few exceptions around wars, very conservative fiscal policy, all right? So that's the policy mix that we have here, but exactly the same kind of histograms we saw before for the whole period apply. This is the interwar period where everything that could go wrong did. So this is a period of great macroeconomic and political instability, but also great political experimentation as nations were trying to, find a way of remaining afloat, right? So for instance, in terms of monetary and exchange rate policy, countries moved from letting their currencies float, pegging them back to gold, and sort of managing their float, right, in, 20 years, right? Massive macroeconomic dislocations. Also, a lot of innovation in terms of fiscal policy. That's, of course, where Keynes made his fame, right? Arguing for a counter-cyclical fiscal policy. But again, same relation in the histograms. This is a period after World War II. This is the Bretton Woods period, and we extend it all the way to the second Latin American debt crisis, right, until 1982. But again, the same thing. If anything, this histogram is flatter, which means that there was almost equal distribution of sizes of debt consolidations in this period. And then finally, the period, the Great Moderation, as lots of people call it, and again, we want to call it also the Great Consolidation from 1983 to 2019, where countries regain monetary stability through inflation targeting, and developing world gets integrated in the waves of global finance and trade and start converging in economic terms. Having spoke about the developing nations, how about income status, right? Are debt consolidation something that only rich nations can get through? So what we did here is that we divided countries by terciles of per capita GDP. Right? And again, you see where the point is going. It's not only rich, it's not only the countries in the top third of the income distribution, historical income distribution worldwide that were able to successfully reduce their debts to high levels. All nations were doing it. Okay, part two, inflation. So where is inflation in all of this? So the first thing you can do is that you can just graphically see, is there a relation between the frequency of debt consolidations and global inflation? And I see some people squinting. It's hard to see these figures. So there's this very up and down volatile series, and this is global inflation. Two measures of it. So the gray version is the median inflation of the whole world, of all all the nations in our data sample. And the blue is the median inflation for the nations that were undergoing debt consolidations by our definition, right? Because you may say that maybe, if there's a role for inflation, maybe only the nations that had higher inflation managed to consolidate their debt. The ones who had lower inflation or even deflation couldn't do it, right? Actually, there's not much of a difference in the medians of inflation of these groups of nations. Of course, we're using median inflation because we don't want the German hyperinflation to blow, or any other hyperinflation to blow this graph out of perception. But in general, at best, right, you could say maybe there's a relation, right? But it's not clear where the relation is, or what's the sign of this relation, right? Higher inflation, more consolidations, or higher inflation, fewer consolidations. So here's two things to think. So here's three high inflation episodes where you actually see local minima in the frequency of debt consolidation. So this is the World War I inflation, World War II inflation, and the 1970s. This is, of course, not mysterious, because countries that fight wars typically borrow a lot to fund the war. That borrowing is frequently accommodated by the central bank. This generates inflation. So essentially, it's the debt process itself that is generated the inflation. Okay? How about the 1970s? Well, maybe you can put a story that, well, this is essentially a representation of the historic policy mistake where countries try to accommodate to stagflation, or rather, to stagnation with inflation, right? And this, of course, is a combination of large government deficits, counter-cyclical fiscal policy again, accommodated by fiscally dependent central banks. All right, we can understand those. How about these, right? I already mentioned the Great Consolidation. How about the turn of the 19th to the 20th century, right? It looks like turns of centuries are good times for consolidations, right? For countries to reduce their debt. Maybe it's some kind of uncautious version of a debt jubilee, right? It's not every 60 years, it's every 100 years, right? But those are indeed two local maxima of the frequency of debt consolidations, and notice how low inflation was during those periods, right? There seems to be a relation, but maybe it's a bit more nuanced. This is a simpler way of representing what I was saying. So we're collapsing all those squiggly lines into bars for our 4 macro historical periods. So that's the classical gold standard. So the dark gray bars represent the frequency of those debt consolidations. What's the percentage of nations undergoing debt consolidations? The light gray bars represent the average overall inflation, or the median overall inflation, excuse me. And the light blue represents the median inflation of the countries undergoing debt consolidations. And with the exception of the interwar period, where countries consolidating had higher inflation than those that were not, the relation is the reverse. So the nations that were more successful at consolidating were the ones that had lower inflation. Okay? All right. Having gone here, then, our plan was to use the standard decomposition of that dynamics. I'm sure you've seen this formula in some version. But let me just remind the notation for those who haven't. So again, we're trying to understand how not debt levels per se, but debt ratios relative to nominal GDP come down. That's the delta small b. What are the possible drivers for this? This is just, this is identity. So the first one is primary budget surpluses, right? That's small d. If governments run primary budget surpluses, this reduces debt accumulation, actually moves it into negative territory. So that's one. Interest rates, real interest rates never help in this story. Because, usually if you borrow for an interest, with the exception of the recent period where this is a complete historic anomaly to my knowledge. And if, we went through this really weird period where you had negative nominal interest rates, right? It's unclear whether that translated into negative real interest rates, but that's really an historical anomaly. Even I have never come across anything like that. And if any of you knows of a historical period of negative nominal interest rates, please come and talk to me about it. So this never helps, right? So interest rates always push the debt level up, so it's never going to help in explaining debt consolidation. Real growth, this idea that countries sometimes can grow out of their debts. People on the Keynesian side of the profession, after the global financial crisis, were castigating the turn into financial austerity, saying that this was adding insult to injury. The economy just came out of a profound aggregate demand-driven crisis. You're making it worse by trying to generate budget surpluses all around the world. You should reverse, trust the Keynesian fiscal multiplier. If you spend more, you recover the economy faster. And of course, this central term is the famous R minus G condition that has been considerably studied and discussed ever since Olivier Blanchard gave that speech at the American Economic Association. And then finally, there's a balancing element here. So this really turns into identity. The IMF authors of this report, they call it the stock flow adjustment. And this is necessary such that in each period, changes in the debt stock match with what's happening with the flow. And the flow is the budget surplus or deficit, because there are occasions where that changes for reasons unrelated to the budget. Okay? Usually if you have a budget deficit, you need to borrow, right? If you have 2% budget deficit, you need to increase that by 2%, right? But on some occasions, that's not the case, right? So what are those? Debt conversions, I already mentioned. There are occasions where governments get away with converting existing debt stocks into less favorable new debt for their creditors, changing the principal outstanding as a consequence of that. Debt equity swaps, even if you don't think of privatizations and nationalizations in this way, that's effectively what they are. So if a government sell a state asset, a national asset, they get money out of that has nothing to do with the state of the budget. And frequently what nations who do privatizations do is that they use that money to retire public debt. Okay? And that's unrelated to the budget deficit. It's unrelated to any of these elements. Or the reverse. Nations who decide to nationalize parts of their economy, they have to borrow to buy those assets, right? And this again is unrelated to the budget deficit. And then, of course, more obvious things, if a government decides to bail out their banks, or if a government participates in an international lending in favor of another nation, right? So those can also change the debt stock. Okay? We also need these for this to balance. Okay. But what you notice is that I haven't mentioned the word inflation in any of that, right? And it's flagrant that inflation is missing here. I guess it's understandable because inflation worldwide was so low. When I used to teach macroeconomics to my students, 10 years ago, when I got to inflation, my first table would be, so here's the world distribution of inflation. This is the country with the highest inflation, the country with the lowest inflation, and it was really boring, right? Because the country with the highest inflation had, 3.4, and the one with the lowest inflation had 0.6. I said, see, finally macroeconomics proved to be useful, right? Inflation target is the way to go. All right. But then, so I guess it was understandable that nobody bothered with thinking what's been the contribution of inflation to debt consolidations. Well, actually, inflation is there, right? It's just hiding, right? Through a passive magic, you can add and subtract inflation. And so if you subtract inflation from real interest rates, you get nominal interest rates. If you add inflation to real growth rates, you have the growth rate of nominal GDP. But that doesn't help much, right? Because notice, if you add and subtract the same thing, it cancels, right? So we haven't learned anything. Now, this would be correct, but under extremely restrictive assumptions. This would only work in a world where debt is inflation indexed, or if it's not inflation indexed, investors and markets are smart enough that they have perfect foresight of a future inflation. And so the inflation premium incorporated in today's debt already forecasts perfectly future inflation. When does that happen? And finally, this would also be in a world where governments only issued 1-year bonds, such that they had to refund all their debt all the time, which of course never happens. Okay, so this is complicated, right? I told you that one of my co-authors works for the IMF. And when we were thinking about this paper, she sent me some internal notes. They had been discussing how to come up with a revised formula, and it quickly gets very complicated because, so I mentioned that the previous decomposition would only work if you had only 1-year bonds. How about if you don't have 1-year bonds? You have longer bonds. Okay, then we need to distinguish between the 1-year bonds. This phi would be the fraction of 1-year bonds that have to be refunded every year, right? In which case inflation does indeed cancel. And then all the other long duration bonds that had a fixed coupon that is not going to be changed, except if it's indexed. And in that case, for that part of the debt, then yes, inflation can inflate it away, right? Because unexpected higher inflation at the time that it was issued was not incorporated in the coupon payments. What is inflation? There's another complication, right? Well, what's the relevant price level for real GDP? It's probably the deflator. What's the relative required price level for investors? Probably not the deflator, it's their own consumer price index. So this introduces another kind of worms. What kind of price levels are we going to use? And by the way, is it the CPI of the issuing country, or is it the CPI of the investors, right? So this gets very complicated very quickly. And remember, we were ambitious enough. We wanted to go back to 1800, so this is not the way to go. But turns out there's a very easy shortcut. And the shortcut is just to use the data published by the governments themselves. Right? Every year, governments publish their budgets or their financial accounts, and they say how much they expect or how much they paid in actual interest on the debt they own. Right? They don't tell you, what's the average maturity. Now they do, but they didn't used to. Right? They don't going to tell you the maturity. They're going to tell you, we think that our investors care more about U.S. prices than our own. They're not doing anything. They just say we paid this many million in interest, and this is how many billion we have in debt. So effectively, all the information on the average maturity, the relevant price level, when the debt was issued is already there. Okay? And since we're historians, we're essentially looking into the past. We're doing all of this retrospectively. This is the only thing we need. Then we also do a little bit of algebra of our own. We come up with a new formula that identifies the contribution of inflation for these debt consolidations. Of course, I'm not going to bother you with that. If you're curious, go and look at the paper. Just going to say that this is an exact decomposition. Because after 2021, lots of people started to say, okay, we need inflation in this formula. But most people use approximations. We don't have to do that. So we do the exact decomposition. Right, let me give you an example what we can do with this. This is a presentation about financial history, but we're ambitious enough that we pushed history until 2019. So I'm actually, since we're in Germany, I'm actually going to exemplify how you can use this formula with a recent debt consolidation episode involving Germany between 2011 and 2019. In these 10 years, the debt to GDP ratio in Germany came down by 14.7%. You probably know this. This yellow line is the evolution of this ratio over time, right, in each year. So as you can see, for almost all years, it's below zero. So this means that debt was coming down, except for the exception in 2012. There was a moment where debt over GDP ratio went up a little bit. And now what I'm going to show you is an increment of the contributions of each of those 5 factors that I mentioned earlier on. Okay? So let's start with the one that never helps. That's nominal interest rates, right? They're in the positive side of this graph. So they're going against the grain, right? The grain is to be on the negative side. Anything that is on the positive side is not helping, is pushing debt to go up. Okay? So indeed, even Germany on average did not pay negative interest rates, nominal interest rates over this period. But of course, you notice that interest rates were coming down a lot. They halved. Now, these are not the interest rates you would see quoted on your favorite source of financial information, right? Being a newspaper or a website. Those are the secondary market yields. These are the coupon payments incorporated in the existing debt, okay? But of course, throughout this period, Germany was refunding part of its debt, and it was refunding at lower and lower and lower and lower secondary market yields, which then, by the law of averages, means that the share, as a share of GDP, the German government that used to pay close to 1.7% of GDP in interest came down at the end, paying less than half a percentage point. Okay, big contribution of lowering yields. Okay, so that's one. Second, what did the government do? The government, as you know, sustained primary budget surpluses. Primary in the sense excluding interest, right? Or the average of 1.1% of GDP. Now, this helped. As you can see, there's some years where it helped more, right? Where these bars are bigger, pushed the debt ratio further down, because these were years of higher primary budget surpluses. So that's to be expected. Second contribution, growth. Now, growth was not exceptional, or maybe it was what was normal to expect of a nation such as Germany. It averaged 1.7% in real terms. This is real growth, not nominal growth. There's some good years. 2011 was a good growth year. 2014, second one. This also contributes in every single year to reduce the debt burden. So it's not just pure fiscal austerity, right? The economy was also helping. And inflation. Yes, there was a role for inflation. Inflation was 1.4% on average, but again, because governments issue their bonds mostly in nominal terms, inflation is always going to help a bit, right? And indeed, it helped a bit in this period as well. So those are the green shaded bars. And then finally, there's the balancing element. That's the rose element. On average, it didn't really matter because this positive cancels with this negative. But if I were to ask you, the way to interpret the positive contribution here is that something made the German government borrow more in 2012 than what they need for their budget needs. Actually, they did nothing because they were running a budget surplus. So why did they borrow in 2012? Do you know? Yeah?
I guess the German government wants to keep an interest in order to provide the whole market with German debt.
That's a recomposition effect, right? I know that governments issue all the time constant maturity debt, right? So they do that all the time, but that just recomposes the debt, right? This is a net increase in the overall debt level.
I suppose they borrowed more than they needed because they wanted to borrow in a steady way.
I don't think that's... Anyone else? Yeah? Yes, exactly, right? So this is 45 billion contribution of Germany for the ESM and the ESFS, right? So this is one of those cases where that can go up unrelated to the domestic budget. And what happened here? This is the other way around. So something else happened outside of the budget that helped to reduce German debt. What happened in 2015? Have you heard of spectrum auctions? Right? Telecoms, exactly. 2015 was the last spectrum auction in Germany, generated a lot of money. The government used it entirely to retire debt, right? So this makes sense. This is not dark magic, right? So these figures do make sense. And if you want to summarize it all, here it is, the summary. So 14.7% was the cumulated debt reduction over these 10 years. There's a confusing element here because nominal interest rates never help in reducing debt. Their contribution is always negative in the sense that it goes the other way around, okay? So interest rates contribute negatively with 54% of this debt reduction. This means that if nothing happened to all the other elements, that would actually have gone up by half of this, okay? The other ones, you read them directly, right? So the primary bolus, right, this ongoing primary budget surplus contributed 2/3 of the consolidation, real growth almost half, and inflation a bit more than 1/3. And of course, these do not end up to 100 unless you add the minus 54, okay? But that's the way to read this. You can still get the relative magnitudes correct, right? So what was more important here? Definitely the fiscal effort, but it wasn't the whole thing, all right? Growth and inflation helped. The stock flow adjustment just washed. Okay, so here's an example close to your hearts. But again, we do this since 1800, and in so doing, we find all manner of different consolidations. There are many ways for countries to consolidate their debts. So there have been, in history, many ways for countries to consolidate their debts. So fiscal consolidations, those that are mostly driven by fiscal effort. I already showed you the German example. I won't show another one. Growth consolidations, the rare but very happy moments where some unexpected source of growth comes your way, and that allows you to, painlessly consolidate your debt down. This is, of course, not policy actionable, right? You can't just say, the way to solve your debt sustainability problem is to come up with a magic growth tree, right? So that's not really policy relevant, but there are historical cases where that happened. And then there's inflation with two sub-variants. One variant, inflation consolidations are frequently associated with negative interest rates in real terms, but it's not a necessary condition. It's still possible that inflation can still help growth with positive real interest rates if the nominal GDP grows fast enough. But frequently, consolidations associated with large contributions of inflation are also related to negative real interest rates. I'll show you evidence on that. Variation of that is where the government enforces the inflationary consolidation. So these are cases of so-called financial repression, where, for instance, the government does not allow the nominal yields in the secondary market to go up, right? Or leans on the central bank to scoop up all the new issues of debt, or worse, forces the central bank to price a floor on the price of new and existing government bonds to keep a low interest rate, or where the government, in more heavy-handed examples, for instance, forces the commercial banking sector to buy large stocks of government debt, which effectively is creating a protected market, right, for the government bonds, which surprisingly turns into low interest rates. At the same time that perhaps on another part, the government is also leaning on the central bank to increase credit, so you can have both at the same time. Ridiculously low and compressed interest rates and high inflation, which of course is going to consolidate your debt very quickly. Okay, right, so here's an example of a growth consolidation. This is Canada at the turn of the century, the past century again, right? From 1896 to 1905, Canadian debt over GDP fell by more than a fifth of Canadian GDP. The most important element, you can see the blue dominates here, right? So growth really brought down this debt over GDP. The government helped. Notice this was a very financially conservative government. Primary budget surpluses throughout. But definitely, growth was twice as important as fiscal stringency. Where did this come from? Well, if you know a little bit of Canadian history, this is the moment of the settlement of the central and western provinces. So this was a period of very intense immigration, very intense settlement and exploitation of new arable land. And it's also a period of very large capital inflows to the tune of about 4% a year. So in 10 years, 40% of GDP, of Canadian GDP, was invested from abroad into the nation. So of course, once you have all of those combinations, the country had to grow like crazy. And the average real growth rate of Canada in these 10 years was 7%. Okay? But again, perhaps President Trump is in the process of generating something like this by saying, I want Greenland, thank you very much. But it's not really a policy actionable recommendation that, just grow a country, right? Double your size, right? So that's something that very infrequently happens, but it happened to Canada. Inflation cum repression. This is one example. This is typical of the post-World War II period, right? Most major belligerents did exactly the same. So this is France. So France, despite everything that was happening politically and economically after World War II, managed to reduce the size of their debt by 1/3 of the GDP over 10 years, right? That's 33%. How did they do this? Well, it's graphically obvious that there's two stages to this, right? There's a complicated first stage and there's a second, more stable stage. Most of the debt reduction happens during the first period. So of course, in the first 2 years, this is inflation. Actually, what happened in 47-48 is that the government asked the Banque de France to buy all public debt around. They did, and that generated massive inflation, over 50%. 50% inflation, of course, that's going to have an impact on your debt ratio. The other thing you notice is that the government wasn't helping, right? You didn't have primary budget surpluses, you had primary budget deficits. And this is largely related not only to the reconstruction and dislocation of the war, but also to the colonial war in Indochina, which was extremely expensive, right? Now, even the government got spooked with 50% inflation. So in September 48, the Treasury and the Bank got together and they agreed on not to do the same, right? And the government promised not to monetize the deficit, although the deficit was still there, right? And in exchange, the Bank of France would lean onto the commercial banks and force the commercial banks to maintain a floor level of government budget holdings in their balance sheets. Effectively, they were preventing the banks from selling their stocks of government bonds. What was the consequence of that? Can you see the contribution of the nominal interest rate? You see these tiny light gray bars? This is essentially interest rate compression because of all the regulation and all the impositions of the Treasury and the Bank of France onto the commercial sector, banking sector, right? So despite of having this enormous inflation, nominal yields were still ridiculously low. And they didn't bulge, okay? And then the second part, this coincides with the abandonment of Indochina by France in 1953. Budget deficit disappears, inflation disappears, and now everything moves on to a moderation period, right? All the nominal and real variables come down, but actually most of the debt reduction had been accomplished already. All right, so we saw an example of growth, right? Fiscal austerity, growth, inflation with repression, inflation with less repression. Cross the English Channel into the UK, another debt consolidation of about the same magnitude, 1/3 of GDP over 10 years, 69 to 78. This is, of course, the period of the great inflation, right? So it's unsurprising that inflation, you have lots of green in this graph. Inflation in the UK in this period was on average 12%. It peaked at 24% in 1975, which of course is the largest bar there. But it's not the only thing going on, right? The government actually initially, despite everything that has been written about stagflation and policy mistakes and so on, the government initially was actually running pretty hefty budget surpluses. All of this changed in 1973 with the oil shock, and that's the beginning of the policy mistake. Even though the scale of the deficits is not to be excited, right? Then there's also a little bit of contribution of growth initially, but then this again gets killed with the oil shock. And then finally, notice that the light gray bars, as opposed to the French case, they're much bigger. So essentially the markets were indeed reacting, and they were charging a hefty inflation premium to the new refunded debt in the market, okay? Why? Because this is precisely the period where the British government starts relieving all the financial restrictions and regulation on the banking sector and capital markets. By 1979, they abolished the last capital controls and exchange controls. And so, of course, the markets were reacting as they were being allowed to do it. Now, I mentioned that most inflation consolidations or inflation-driven consolidations are associated with negative real interest rates. It's not unnecessary, but it's almost a sufficient condition, okay? So a virtue of this decomposition is that all these elements can be added, okay? So if you want to see what's the contribution of the real interest rate rather than the nominal interest rate or inflation separately, right? You can just subtract one of these, you can subtract these bars, the gray bars, from the green bars, right? What I've highlighted here, okay? In years where the green bars are larger than the gray bars, this means that the real interest rate contributed negatively in the sense that it helped to reduce the debt ratio, okay? So we also thought about this, right? And we have another summary table, which is the one that comes just next. And essentially what you have here is a new way of looking at the contribution of inflation, right? So what we do is that we pick these two values, the nominal interest rate and inflation, and we subtract one from the other. So in this case, inflation would still contribute positively despite the hike in nominal interest rates to the tune of about 40-something%, okay? If we do this on average for the whole period, we get a contribution of 18%. This is also interesting, right? Because, when I talk about this project, the more skeptical among our colleagues would say, yeah, but this can't be a long-term solution because, of course, market yields will hike and then governments will face higher refunding costs and all the gains from inflation will disappear. Maybe today that's the case in today's world, but over the whole period, you see that fully 18% of these debt consolidations can still be explained by inflation, even when you take into consideration nominal interest rates. If you break down by the 4 macro periods, you notice that this is purely a post-World War II phenomenon. Most of it in the period between World War II and the Latin American debt crisis, that's Bretton Woods, that's heightened financial regulation, this is before the big bang of financial regulation. Unsurprisingly, half of all debt consolidations were explained by inflation, even taking into consideration what was happening in the secondary market, okay? Now, of course, with financial regulation, deregulation, that came down, but it's still around 25% over the more recent period, okay? So again, we don't think that inflation should be trivialized. We don't think that you should think of the contribution of inflation for debt stability just over the short run whenever the inflation shock is unexpected. Nobody saw it coming. It wasn't reflected fast enough into the refunding costs because we have a lot of consolidation over cases over very long periods that belie that. Now, the other periods are the ones where actually, if you take into consideration the reaction of yields, you get what might be more intuitive, which is the negative contribution. So essentially, these were periods where interest rates adapted faster than inflation. But then again, the pre-World War I period was a period where median inflation was 0, right? So there wasn't much to inflate away. There's ups and downs, but on average, over a long period of time, this couldn't have mattered. But it's also a period of initially very high nominal yields, especially for emerging nations, although this came down all the way to the eve of World War I. And of course, in the interwar period, all hell broke loose, right? And it was hard to issue or refund anything because markets were shutting themselves. And there was also a period of lots of defaults. Okay. Now, what I've shown you are essentially exercises in retrospective accounting. So if you want, it's almost like teaching you empirical growth theory, only looking at the proximate sources of growth without telling you anything of what allows for those sources of growth. So I don't want to end without saying something about that. The ability for countries to consolidate their debt depend on a number of structural characteristics, starting with their debt management, the type of debt that they issue. I already mentioned, it's very hard to inflate away short-term bonds. One-year bonds is almost impossible. Longer-term bonds is easier. There's been cyclical or secular trends in the variation of debt maturity of public debt. For a period, countries were actually issuing shorter and shorter bonds. Then with the global financial crisis, a zero lower bound, they opened up to the idea of issuing longer bonds, also to massage the long part of the yield curve. But in general, the shorter the maturity, the shorter the average maturity, the harder for inflation to do anything for debt levels. Then there's indexation. If your debt is indexed to prices, of course, by definition, you cannot inflate it away. This is an historical example. Israel, right? Israel in the 1980s went through a period of very hard, almost hyperinflation period, right? There were years where inflation went above 300%. And the only way they could convince anyone to hold their bonds was to index them, right? So even in 1995, when they had almost won over inflation, 4/5 of all outstanding debt were indexed to CPI. And even today, it's between 30 and 40%. I think Israel is the most indexed nation in the world, to the best of my knowledge. So, of course, they could not have inflated away their debts. Related issue is the currency of issue and the story about original sin. As we know, even today, emerging and developing nations frequently have to borrow a lot in foreign currencies that they do not control, so they cannot inflate away either. Do we have data about how important this was? Turns out we do. So there's a very nice report published by the United Nations in 1948 on the global debt stocks. And if we consider only the emerging and developing nations at that period, by 1913, 48% of their debt stocks were issued in their currencies, which means that 52 were issued in currencies they did not control, right? So they could never inflate at least half of their debt. But what's interesting is that barely 20 years after, 1935, 74% of their debt stocks were already issued in their domestic currency, right? Again, the interwar is a period where everything happens, including this massive change in the funding structure of emerging nations, which of course is related with the Great Depression and the shutdown of first London and then New York, the two big capital markets, to the issues of debt by developing nations. Also interesting, here's a fun fact, right? The BIS published a report in 2023 where they also spliced the debt of representative emerging nations today. And 76%, which is essentially the same as in 1935, is issued in domestic currency. Okay? So again, now it seems that emerging nations have bigger firepower to inflate their debts if they wanted to. But of course, they need to be careful with the reaction of the capital markets to that. Then, of course, here comes the reaction of capital markets, expectations. How are these expectations of inflation formed? How are they incorporated into the debt market and all that complicated stuff? Even today, we have trouble understanding how people alive today form their inflation expectations. Of course, we can't do anything about those who have been dead for a century, right? So that's why we didn't go that way. But of course, if you're wanting to think forward, you need to take this in consideration. There's also questions of how much you lean over your central banks, in the worst case of fiscal dominance. Can you still get away with using financial repression to massage the market for your government bonds? The importance of monetary anchors to stabilize inflation expectations. So of course, we know everything about the inflation targeting period since the 1990s. How much of you know what happened at the tail end of the classical gold standard? And essentially what happens after 1896, more or less, which, remember, is when Canada starts growing like crazy, is a wave of large gold discoveries. And at a time where all countries, almost, were pegged to gold, and so had no control over their money supply, the only way to get monetary and nominal expansion was if you were lucky enough to discover gold. Turns out the world discovered a huge amount of gold between 1896 and 1899. So there was a coordinated monetary injection in the world that generated positive inflation. Not out of control inflation, but positive inflation that definitely helped with consolidation. And then, if you prefer to believe in the fiscal theory of the price level, right? Maybe inflation is not driven by monetary shocks or central banks, it's driven by the intertemporal budget constraint of the government. The imposition of credible and actionable fiscal rules definitely matters to achieve successful debt consolidations. And in the end, if we talk about the government, we always have to talk about politics. All ends up with political economy, the type of political regime you have, the degree of representation, the autonomy of policymakers, namely of the central bank, right? Independent central bankers, all of these will matter. And I'm getting to the end, but I want to end with a provocation. So this really makes no sense, I admit. This is a retrospective accounting of the future, right? Or at least as best as the IMF can predict the future for the Eurozone, right? So this is a mix of data, things we actually know. This is the first 3 years, with the latest forecast of the IMF for the Eurozone from October last year. And so, you can use this data and use our retrospective accounting, right? And see, okay, so what does this tell us? To be honest, the table above only refers to the first 3 years. So these are years where debt over GDP in the Eurozone came down by almost 9%. It's not the 10%, they would make the cut for our, algorithm, but it's close to there. And as you can see, the vast majority of this debt reduction was due to inflation. Was it expected? Was it not expected? Was it policy induced? However it was, that's the fact, okay? There's also contributions of the other ones. Again, the budget didn't help, right? The Eurozone was running primary budget deficits. And then from then on, I don't really think we can trust this. It looks remarkably stable, but I guess that's the problem with these big macro models, right? They're too stable. So I would leave it, but here's some food for thought. So what have we done? So I showed you evidence of patterns of debt consolidation that, to the best of our knowledge, have been unnoticed until today. Here's a reason to do a bit of economic and financial history. Sometimes you're surprised. So we find consolidations tend to follow large wars, we'd expect it, but they're not always driven by the monetary overhand of those wars, as Keynes was worried about in 1919. They are equal opportunities, right? All manner of nations get to consolidate their debt, low, middle, and high-income nations. They've been more frequent than defaults and debt reliefs, and more significant in terms of the size of the debt reduction, right? They're more frequent and they're larger. We find only a weak correlation with inflation. That's not hard to understand because inflation is endogenous to your policy stance. And again, coming back to how I previewed the results, we find, yes, that what's really important is to keep credible policy rules that anchor inflation expectations, not at zero, but a small positive. It just needs to be a small positive to have a significant, over a significant long period, effect on debt consolidations. Interest rates markets frequently react in non-helpful ways if you want it, and all of this depends on what kind of policy rules you follow, monetarily and fiscal policies, and also on the degree of financial regulation of the capital markets. And although I'm a financial historian, I cannot help myself from, sharing some speculations about the future. Okay, so what should we expect in terms of debt consolidations? How is the world going to consolidate that debt mountain with which I started? The conclusion is sober. I don't think there's any easy fixes. Should we expect very significant and large primary surpluses worldwide? I don't see how, right? At the moment that all pressure is to increase government spending, either to fund the green transition or the Zeitenwende, at the same time that the levels of political polarization and disagreement on what the government should do with taxpayer money are on the high. Should we expect big unexpected growth? About maybe AI, right? Maybe DeepSeek and all of that, right? Maybe you're on the cusp of something really big that is going to make all of this a moot point, but I don't know. Financial liberalization, I mean, it's hard to walk back. Can we expect governments to be able to compress their financial sectors as they used to do, say, after World War II? It's hard to think how, although some countries still try to do that, like China. Inflation, how about inflation? Is inflation going to help? I'm going to hedge my bet, right? Since I'm forcing myself to make a highly speculative prediction. I also don't think that in the long run it can help, but in the short run, combined with credible monetary and fiscal arrangements, I think that a little bit of monetary flexibility definitely will help. And with this, I thank you very much.
Rui, thank you very much for this fascinating speech. I think the entire room was really caught by your thoughtful insights. And I think there are a lot of questions around here. So, please. And if you could kindly introduce yourself.
Did my PhD here at the House of Finance, and now I work at a large European bank. Thanks for this super interesting talk. I think it's a really cool topic. The question I wonder a bit is the methodology that you use the right one for these type of questions? Because, I mean, you don't have a large data set. You could do also qualitative analysis. And if I can quote maybe the FT, who was very critical of the Nobel Prize last year, basically saying the Nobel of econsplaining, you target a topic that is maybe like really history with like approaches that we use in economics really for numbers that might forget a lot about important things. So it's more like a methodological question.
Shall I answer? Yeah, I partly agree, right? And indeed, we do have a series of case studies where we explain exactly how nations did this. So all the figures I've shown you, we have it in the paper, and you can read the case studies, right? So we do that. We're not turning this into a cross-country panel regret. Yeah, we're not doing any of that. But we still think that the methodology is important for the decomposition, to understand the type, the different types of consolidations, right? If you look at Canada and Argentina, what we do is that we do paired comparisons, right? And so one of the pairs is precisely the Canadian case I showed you with Argentina at the same time. And they're very different. Even though the monetary regime was the same, they were both very rich, endowedly rich nations exporting natural resources. The consolidation in Argentina had a much different combination of growth and fiscal stress and so on than the Canadian one. So you still need the little bit of decomposition to be able to classify the types. Or for instance, in the case of Germany, remember when I saw because I wanted to give a German example, right? But when I saw the pink factor, I said, oh my God, this is probably some error, right? There's some mistake. Then I went to the reports of the Deutsche Bundesbank, and there it was. I said, right? Of course, I hadn't heard about the spectrum auction either, right? But it makes sense, right? So this is a way of, I guess, organizing the narrative that you're going then to write, right? Because before you see the decomposition, you may have your own priors, right? What drove the German debt consolidation of the 2000s or the 2010s, but you actually don't get all the information. So this forces you to think before you write those case studies.
Yeah, thank you very much. I loved your presentation. Thank you. I was very surprised by the positive impact of inflation that you find in the post-World War II era for debt consolidation, even if it's at moderate levels, let's say, since the 1980s. I wonder how much is that related, what do you think, to the structural decline in the real interest rate, savings glut hypothesis, and what if that were to change in the future?
Of course it's related, right? I mean, all of the, connecting your two questions, right? So we do look this country by country, right? So you can write many case studies, right? So our data is available, you can download it, and you look at what caught your attention and so on. But of course, there's worldwide trends as well, right? I was just referring to worldwide inflation after the discovery of gold. There's also a savings glut. By the way, there's also a savings glut in the late 19th century. So the world level of interest rate was on a downward trend, right? Possibly related to similar macro trends than the ones that applied in the early 21st century. Again, that seems to be something specific about the turns of century, right? For some reason. And of course, the other thing that happened, I don't know if I still have the picture here. My cheating exercise. Look at what happens here, right? Even the forecasts are not really saying that the markets are going to give you an easy ride, right? So the size of the light gray, which is the negative contribution of hike in nominal interest rates, are actually going to make this consolidation harder, okay? And this, of course, is related to the return of higher interest rates. There was a question there, the lady in green.
Hi, thank you very much. I have a very general and maybe provoking question. That is, why is it important for countries to reduce and consolidate their debts if their debts are issued in its own currency?
Oh.
Because one thing to add, because isn't it the case that public debt is automatically creating public but also private wealth, which is in general a good thing?
Yeah, you're getting me into tricky territory there, right? I mean, there's even a more extreme version that goes by the name of the modern monetary theory, right? That says that this is just one side of the government and the other side of the government. We need to stop pretending that they're separate. I don't believe that. Governments can do great things with public debt. Remember the title of our book, In Defense of. But this is not a one-way street. Right, there have to be moments where you have to recover your ability to counter-cyclically stimulate the economy. You can't have pro-cyclical fiscal policy because that's not going to help with stabilization, I guess, in any kind of model, right? So once the emergency or once the long-term investment need subsides or is met, then you probably should enjoy the consequences of growth if you invested in the correct things, and to let your debt level go down. Because a future emergency will come up, and you know that in order to sell this debt, you need to have someone to buy them, with the exception of pathologic cases, right? Of the paradox of thrift in big aggregate demand shocks. You may be confronted with the wrong type of aggregate supply shock, and then inflation, and that is not going to help, right? So I guess there's a cautionary rule. Right? Governments should really try to aim for counter-cyclical fiscal policies, and this will have to have a reflection on their debt levels.
This works?
I can hear, yeah.
Oh.
Jumping to your conclusions, I wrote something like some monetary flexibility, which I assume means higher inflation. In that case, I would.
Yeah, I need to be careful, especially since we have a central banker here. What I want to say here, historically, I think I've shown you that low, stable, predictable inflation levels have helped around the corner for governments to reduce their debt levels. Right? Inflation above 0, it doesn't have to be 10%, doesn't have to be 8%, even 2% can help, right? And debt consolidations frequently are not easy, right? If you have to trade off between 2% primary surplus or 1% primary surplus and 1% inflation, why wouldn't you do that, right? So what I want to say is that even moderate, stable, and predictable inflation can help with debt consolidations. How do we get that? Because markets allow you to, so long as people do not massively change their expectations such that they start charging in anticipation inflation premium that makes your consolidation much harder. So maybe that's what I want to say.
I'm fine with that, but in that case, I think precision would just help because given the context you were talking about, some monetary flexibility could mean higher inflation as well as if some people talk about higher fiscal flexibility, they mean higher public debt. What I was aiming at is if you think of higher inflation, it's more, and you mean more than just 2 or 3%, then you could create more political polarization, as you mentioned, and then you could have higher government expenditure, and then you're in a vicious circle.
And if you force more austere budgets onto your economy, doesn't that increase polarization as well? I mean, there's empirical evidence connecting austerity and polarization in Western European nations, right? In the end, inflation is also a tax, right? But it's not a cut in government spending, which people react to more immediately. And if you, again, it's all an argument about margins, right? I'm definitely not endorsing that governments, I don't know, that you should say, yeah, the ECB now believes in 5% inflation target, right? No, because that would destabilize even the inflation formation process. No, that would be irresponsible and very dangerous. But why should we worry if inflation is 2.4%, maybe 2.5, 2.6? So, but again, this is not. I'm not in the business of offering policy recommendations today, right? What I just want to say is that historical evidence shows that moderate, predictable, even predictable inflation helps, right? Not runaway, unsustainable inflation in the context of macroeconomic disequilibrium. That doesn't. Yeah.
Thank you again for your insightful presentation. Is there an analysis also on the difference of the contribution dependent on the point where you start? At which level debt, public debt you start?
Yeah, you can do that. I haven't done that. I didn't splice the data this way. Right? If you start, the stylized facts there is that if you start with higher debt over GDP levels, you tend to find more contribution from the budget. So when governments are really against the wall, right, it's easier to generate a political consensus to reduce debt over GDP. So let me give you a concrete example. Not an obvious one. It's not Liberia, but it's Jamaica. So Jamaica, over the last 10 years, has had a fantastic success at reducing their debt levels. All right, I forget exactly the magnitude is between 40 and 50% of their GDP. They managed to bring it down. Yeah, so there you are, right? How did they do it, right? So they do not exactly come from a background of very stable monetary policy or fiscal policy or very stable political or anyway, but they managed, the problem became so salient. They really managed to generate a political agreement on two sides of the political aisle. They created fiscal rules that were credible and observable so that the rest of society could buy in and investors could react. Because it's one thing to say that, yeah, both of us commit to generate budget surpluses, but the other thing is actually delivering on them. But if the communication to the wider economy and society becomes faster and more agile and it's easier to see what the government is doing, of course, this is very similar to what central banks do, right? Communicate the stance of monetary policy. Actually, the outcome is a unmitigated success, right? And they've been able, you say that you've been following, right? But they started from a very dangerous level, right? And so in that case, it was easier to generate the political equilibrium to reduce it through budget austerity.
You already mentioned the Bank of France and the purchase of government bonds as an instrument for consolidation, which has obviously reduced yields, and the ECB did the same. What are the observations in general on the history of central bank cooperation? Did this reduce or helps to consolidate public debt? I mean,
cooperation between central banks?
Between central banks, for example, these famous FX swap lines between the G7 countries. My assumption would be if you are part of such a swap line and you issued debt in a foreign currency, it's much easier, to reduce the burden here and consolidate.
Reduce the burden, that depends, right? It depends on the strategic, whether you use them strategically or just as an insurance mechanism, right? If you think of Argentina, yes, they've been using it very strategically, converting the renminbi into dollars and, to try to strategically draw down the expensive dollar debt. But of course, that depends on the considerable amount of cooperation on the other side, on the counterpart, on the People's Bank, right? Yeah. So, and I don't think the Fed has the same appetite to be on the other side of these kind of transactions.
Are there any famous other examples beside like the G7 or Argentina and China, which you would...
Swaps.
Yeah, swaps too.
No, you catch me unprepared on that. I'm just going to assume that swaps are relatively recent, at least at the level that you're referring. The only thing that similarly that I find in history are very episodical instances of central bank direct cooperation, but this is usually to avert financial crisis, right? So there's this famous case around 1890, the first Barings crisis, that was almost on the verge of bringing down the London financial center, and the Bank of England got some cooperation from the Reichsbank, the Banque de France, and the Imperial Russian Bank. Back then, swaps were not available, so they literally put some gold bars into ships and sent them to London. And the Bank of England announced that, yeah, we have the Russian and the French and the gold, right? And of course, once everything was settled, the bars just went back where they came from, right? But that was specifically to avert a financial crisis, not to do any favor to the government, right? And I don't think there was any level of cooperation at that level. Then in the interwar, with the creation of the BIS and some very active central bankers, right? The stories about Montague Norman and Benjamin Strong are very well known. They attempted to do things similar to that, but most of the policy cooperation was done through interest rate management rather than actually committing the balance sheets of their institutions to any kind. But honestly, I'm just reviewing my data banks, right, and see if I can find anything. This is what I can say right now.
One more question? Here, please.
Please, if I look at your paper on the table,
yeah.
I look for a real growth of 96.8%. Is that really probable?
So like I explained, right? So these numbers only add up to 100 if you subtract the negatives, right? And so there was, the interest rates always go the other way around. So the positives have to overcompensate, right? But, if you divide the ratios, you still get the order of magnitudes, right? So in this case, inflation was definitely more important than anything. The second most important was real growth. And the third was, no, that's it, right? Those are the only ones that contributed. Everything else pushed against the grain. There was another question here, I saw. Yeah. So maybe we can still take one more.
I would like to know, you mentioned that before the First World War, there were lots of gold bonds. So lots of governments issued bonds with gold clauses. Mm-hmm. That was the same fineness, the same weight as now. Yep. After the First World War and in the 30s, they abolished that gold pegs. So for $1,000, you didn't get 1,000 gold dollars, but 1,000 paper dollars. Mm-hmm. That is no default. That is no forgiveness of that. Mm-hmm. How did you take that into account, or did you take it into account at all?
Yeah. So is it changing the exchange rate clause of your bonds default or not? That's debatable. right? So there's some people who say that yes, and the most egregious example of that is the US, precisely, right? In 1933, one of the policy innovations, let's call it that way, that FDR did is that he abolished the gold clause on all public and private debt in the US, okay? At the same time that he was having fun with his pals, devaluing the gold value of the dollar, right? You probably know the story. He wanted to surprise the market. Should I say this? Okay, I will, but if you don't like, don't quote me. When I compare historical U.S. presidents, the one that seems closer to Trump to me is precisely FDR. Not in the sense of what he wants to do with the economy of U.S. society. Of course, they're on opposite extremes, but in the sense that FDR apparently really enjoyed surprising the markets and the counterparts, right? And there's a lovely book written by his economic envoy to the London International Monetary Conference of 1933, right? So you know that between 29 and 33, the world was on the way to major crisis. And nations came back in 1933 in London with the aim of restoring the gold standard, okay? And there was a US delegation. The US delegation came up with an agreement with all the other nations, but this had to be ratified, so they cabled back to Washington. Washington said that the president could not be reached because he was on a fishing holiday. Some historians say that he did it on purpose so that he wouldn't be reached. And after many attempts, the envoy gave up, resigned, came back, and started writing very critical books about, the responsible monetary and fiscal and, geopolitical strategy of the FDR administration. All this to say, was that the default? Some authors argue that it was. Sebastian Edwards has precisely a book arguing that was the largest default in the context of the Great Depression. But I guess the majority of the profession still does not call that a default. So we did not exclude the US debt around that period from our database. We don't find a consolidation through our filtering algorithm. But if you want, we could have done that, right? We could have, but that would wipe out the interwar period after 1929. Long answer, sorry.
Very well. If there are no other questions in the room, then thank you very much again for this fascinating speech. A round of applause as well. Well deserved. And I must say personally that you are leaving me with two different feelings. One is very positive because one message you gave us, yes, debt consolidation can be achieved. Yes, we can. On the other hand, if I look at what the largest debtor in the world is currently doing, for example, his debt management, where around 50% of US debt needs to be refinanced in the next 2 years. And all the other incomprehensive measures that the current administration is currently announcing, my feelings are a little mixed. With those mixed feelings, I would like to invite everybody for a get-together outside. Thank you very much for coming.